What's up, stock compounders? Brad here. So it is time for our weekly Q&A, the stock compounder Q&A. So let's get right into it. So the first question, what Warren Buffett quote have I been thinking about this week? And here's the quote: investors should remember that excitement and expenses are their enemies. Okay. Now, I just did the Robinhood, most popular in the last week. And, there's a lot of excitement, it seems like, in terms of investor activity in the markets right now. People are going after the stocks that seem exciting, right? There's huge potential upside for a lot of these stocks. Electric vehicle startups, pharmaceutical companies that may come out with a vaccine that we've all been waiting for. So there's a lot of excitement built in to the activity of at least millennial investors, which are the investors that I've been tracking on Robinhood. And that's a red flag, guys. If something is exciting in your investment portfolio, if you're eyeing up a company and you think, ooh, this is, I'm excited about this investment. It's really worth a gut check if you're having that kind of reaction to a potential investment. One thing Mohnish Pabrai says is, successful investing, successful long-term investing, which is how I define successful investing. It's that compounding over decades. It's really like watching paint dry, okay? There's very little exciting about it. Because if it's exciting, the chances are is you think it can go up very soon, okay? And a lot of those opportunities it feels like they have that potential to go up multiples of where they are within the next week or month. Those tend to be the most risky investment prospects, or what I like to call gambles. Okay. So, I think it's a really solid quote from Buffett. Investors should remember that excitement is their enemy. Now, the expenses piece, obviously, with Robinhood, Robinhood has forced all of these platforms to do away with trading commissions, which, seems great on the surface. But I think there's a flip side to that. And the flip side is, it's easy to think that because we don't have those commissions anymore, doing more can actually benefit our portfolio. So getting in and out of positions more frequently, because we don't have those fees anymore. We don't have that immediate hit to our portfolio of paying those trading commissions. Obviously, the issue is the biggest advantage for long-term investors is patience. So if we're busy getting in and out of positions, the flavor of the week kind of position, we're not letting those great long-term companies compound our money for us, okay? So, and obviously we do have an expense. It's not just trading commissions. That was the expense. We pay taxes. So, if we get in and out of a position in less than a year, we're going to be paying short-term capital gains tax, unless we're in a retirement account, obviously. But so it's important to kind of maintain that long-term investor mindset, and that can be more and more difficult as we've got access to all of these companies, all of these stocks right in our pockets on our smartphones. So it's an important quote to keep in mind. It's probably beneficial for the investor to not have such easy access, or at least not to be checking up on our positions nearly as frequently as we conveniently could just by pulling our phones out. So excitement and expenses, those are really things to avoid in investing. I think that's right on. Question 2. So as you may or may not have seen in a recent video, I've hit my monetization metrics for my YouTube channel. So naturally, I'm not one to spend too much time patting myself on the back when I hit a milestone. I probably don't spend enough time. But of course, I'm looking to, all right, what are my next milestones that I'm targeting? And what comes to mind is, my first paycheck from YouTube is going to be 3 figures. You have to earn at least $100 in a month from ads in order to get a check from YouTube. So that 3-figure, that's my goal right now. I want to get that 3-figure check, whatever that is, maybe a couple $100. And then my goal, I'm already thinking about my next goal. See, this is not what I'm supposed to be doing. My goal after that, I really want to think in terms of compound exponential growth on these kind of paychecks. And the way I'm thinking about doing that is I want to track my views and figure out how, in what time frame are my views doubling, okay? So what is that kind of 2 to the power of for my views on YouTube? Because the views translate directly into my paycheck. The way that YouTube figures out how much they're going to pay people, it's a kind of a cost per 1,000 views, right? So for investing channels, it might be $10 to $15, somewhere in there, per 1,000 views. So that's really going to be the metric I'm targeting and tracking is how long is it taking me to double my views, right? That's kind of that exponential growth curve that I'm going to be watching. So, at this point, the goal is to get that 3-figure paycheck, okay? To hit $100 or however much it is. But then to really be focused on, all right, am I following a compound growth curve? And if I'm not, what do I need to adjust in order to do that? And I was just watching a video from Meet Kevin. You may have heard of Meet Kevin. He's a real estate investor, a little bit in stocks as well, but mostly real estate. And he was talking about how much he made on his YouTube channel in May of 2020. And it was like a $250,000 just in May, in 1 month. So that blew my mind. And then it was kind of cool. He went back to May 2019 and then back to May 2018 just to kind of track what that growth looked like. So May 2020, $250,000. May 2019, just a year prior, 8,300. And then a year before that, it was 2,700. So, that's kind of interesting. It went up like 3 times from 2018 to 2019. And then it went up, just an insane, like 30 times, okay? 3 times and then 30 times. So, exponential growth is exciting stuff. I've just got to keep that at the front of my mind here. Question 3. What's going on with the S&P 500? We're up 2% year to date. The S&P 500 is. But I saw a really interesting breakdown. It looks like the 5 largest companies in the S&P 500 are responsible for a 35% return from the beginning of the year. 35% just in those 5 largest companies. And then the other 495, the rest of the S&P 500, is actually down 5% year to date. So it just got me thinking, the beauty of investing in an index fund passively in the S&P 500 is you're going to have all of the winners in your portfolio. Like if you're a value investor and you're trying to outperform the index and you don't have any of those top 5 companies in your portfolio, it's just that much more challenging to beat the index. Certainly it's possible, Like there are a lot of companies that aren't even in the S&P 500 index that have done better than 35%. But the big challenge, obviously, for us value investors is identifying what those companies are. It's a very difficult game. It just takes a lot of work. So that was just interesting that the top 5 in the S&P 500 are just doing so much better than the rest of the S&P 500. And it's just a good reminder of how hard it is to, as a value investor, I'm sure it's very hard for a lot of us value investors to buy those 5 companies because, they've never really been cheap by valuation standards. I mean, Facebook was pretty interesting not that long ago. I think within the last year it was down at $150 a share. Maybe even in March it was approaching $150 a share. And it was looking pretty compelling to me at that time. Of course, I was just navel gazing. I didn't actually pull the trigger on Facebook back when I should have. But lesson learned. When a stock falls into my buy range on my watch list, buy it. I don't need to put my whole 10% chunk on it or 20% chunk, but start buying into it at when it gets into the buy range. That was the lesson, and I've shared that with you guys in a previous video. And then finally, number 4, what was the favorite comment that I've gotten this week? And I want to do this every week. I think now that my channel is getting more traction, I'm getting some awesome comments from you guys. And I think the favorite one that I got in the last week, I think it was just a few days ago. And it was from Dive the World. And Dive the World, he referenced a Facebook Live video that was done by Phil Town on, someone asked Phil Town, what he thinks about Mohnish Pabrai buying into SRG, Seritage Growth Properties. Pabrai had owned that a couple of years back. I think he sold out in 2017 because he saw the downside potential was just too large at that point. But he bought back in somewhere around $8 a share. And he bought like 12.5% of the common shares outstanding. So he had to file a 13G because he owned more than 10% of this particular class of equity. So it was just somebody asking Phil Town what he thought. And Phil Town gave a really interesting response in terms of how Phil Town would go about assessing the investment. The assessment, the investment, whether or not it's worth investing into SRG, kind of the investment thesis for SRG. Basically what he said is, first he would try to value the land that SRG owns, okay? It's kind of obvious, SRG is a REIT, a real estate investment trust. They own land. And they collect rent on that land, and they're also redeveloping some of those properties. So what is the value of the land? And then he said, what would you be able to sell that land for at like depression level prices? So if SRG had to have a fire sale and raise cash quickly from the land, what would they be able to get for it? Kind of fire sale land value. And then the last piece that Phil mentioned was of the tenants currently paying rent to Seritage Growth Properties, how much rent are they able to collect in this time of this pandemic? How is the pandemic affecting the ability of their tenants to pay rent? Okay, so and another question in my mind is what are the kind of fixed operating costs for Seritage Growth Properties, and that would include the interest payments on that debt from Berkshire Hathaway, which, you know, it looks like Berkshire is working with SRG in terms of allowing those interest payments to happen in the future, allowing them to defer those interest payments. There's a little bit of a extra penalty on top of that if they defer the interest payments. But that's really my plan of attack for SRG. What is the land worth? What is the land worth at fire sale prices if they have to liquidate? You know, assuming, say, if we go into a depression, right? The economy tanks. I mean, obviously the economy is in trouble right now, but could be in worse trouble. And it may be. Who knows what's coming, right, with the pandemic. So what's the land worth? What are they collecting in rents? What are their expenses? And then, you know, what are they going to be able to collect in rents over the next year, 3 years, 5 years, sort of a projection on that. So, you know, it'll be interesting. It'll be interesting to comb through the annual report and the most recent quarterly report to try to piece some of those things together. But if any of you are commercial real estate agents or real estate investors, that could be an awesome skill to have in order to kind of come up with a reasonable value approximation for the land holdings of Seritage Growth Properties. I'd be very curious to get your take on that. Obviously, it's a very nuanced field, which I don't know much about. I did a little bit of real estate investing in single family, but you know, I'm definitely out of my element in the commercial real estate realm. But anyway, guys, that's all I got. Thank you, Dive the World, for that awesome comment, sharing that Q&A with Phil Town. And yeah, that's all I got, guys. If you want me to answer your question next week, let me know in the comments. You know, I'll probably respond with a quick answer, but if it's kind of an in-depth question, I'll go more in-depth in the next Q&A next weekend. And without further ado, thanks for watching. Thank you for your support. It feels really good to be on this train with you guys, learning myself how to become a better investor, and just really this collaborative approach that I've been feeling recently, bouncing ideas off of each other and tackling a lot of these investment questions kind of as a hive mind. It feels empowering to do that. So anyway, I'll see you guys in the next video. Take care.